Hi, Joe Cantu here, and this is episode 41, Uncertainty Spooks the Market.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
So, in this episode, what I'm going to talk about is the fact that the market fell 981 points this Friday, today. And that I'm going to tell you why it fell, what caused it to fall. Then I'm going to tell you our forecast and the big picture. Where's the market going? And, sometimes having a little bit of knowledge helps calm things down, helps you understand the big picture and not to focus on some of the short-term events. But let's get started. So this is an email I send out to my clients and customers, but I'm just going to read off of this to kind of explain today's events and maybe this week, Thursday and Friday's events. So again, the market fell 981 points, and I apologize, but I'll be reading some of it, on the Dow Jones Industrial Average. But what was the series of events that led to the sell-off today? I mean, it was almost 1,000-point sell-off on the Dow Jones Industrial Average. And where is the market going in the future? And what is our forecast? So the basic premise of this podcast today is the fact that to let you know that the market does not like uncertainty. So money managers who actually move the market, they're the big pension managers, the big mutual fund managers, and they like calm and they like certainty. They don't like uncertainty. And when uncertainty unveils itself, then they react and they sell or take profits or do some other things. And we'll talk about that. So money managers get uncomfortable when there is uncertainty in the market, and they will typically start to sell some of their bigger stock positions, perhaps the ones that they have long-term profits in. And it makes sense when you think about it. If you're a money manager out there and you've built some profits in a particular stock or a particular industry or sector, and you had these positions building up for months, and then all of a sudden the wind changes in a particular sector, like healthcare sector or tech sector or something like that in the market, then maybe it's time to take your profit and move on. And I believe that some of that happened today. So let's talk about the actual events leading to the sell-off. So on Thursday, April 21st, 2022, the market started off as a positive day until the Federal Reserve Chairman Powell spoke that day. Now, he wasn't scheduled to speak. I think he was being interviewed. I don't know the actual details of it. I didn't see the program. I read this off my news wires. But he started saying that he might raise interest rates 50 basis points. That's 0.5% next quarter. Now, if you understand that what he's been doing, that the schedule was to raise it, and I say schedule, what he had indicated before is that he's going to raise it 0.25 point per quarter. And that makes more sense, and that's steady, and that's steady for all the money managers to understand that here in the United States. But on that saying that he said that, this immediately reversed the market and then started causing a downward spiral on Thursday. In addition, on Thursday, there were several events happening Thursday, but the Florida State Representatives voted to take away all of Walt Disney's tax incentives for the particular political stance that Walt Disney is taking. And this, what's crazy is Walt Disney stock was already down 30%. I think it went down another 3% on Thursday. But when you think about it, it's those kinds of events that kind of kept the market going, that kept the sell-off occurring. So naturally, if you own Disney stock and you're a portfolio manager and have Disney stock in your portfolio, it's part of the S&P 500, what are you going to do with that position? Well, most likely, based upon the news that they're losing their tax incentive that's going to cause Disney millions and millions of dollars, you're probably going to pull the plug and sell it. Again, it makes sense that that's what you would do. So, in a particular day, if the market was moving up, people who own that big Disney position, they'll probably be selling off. They were already losing subscribers from Disney Channel anyway. So the Dow closed down for the day, for Thursday. Number 3, Friday morning, Caterpillar stock, which is a Dow Jones Industrial Average stock and in the S&P 500, reported earnings. And they beat revenue by, their revenue was $13.8 billion, and they beat earnings at $2.69 a share. The consensus estimates were they expected to come in at $13.5 billion, and so they actually beat that number by $13.8 billion. And then consensus estimates on the earnings per share were $2.65, but they actually beat that number too and came in with $2.69. But what's crazy about all of that is that many analysts felt that, and you got to realize what Caterpillar is. They make tractors, they use steel. So other analysts felt that with the rising prices of steel and other commodities in this inflationary environment, that it will cause the future earnings of Caterpillar to be lower. So that's what started the sell-off. Caterpillar started the sell-off in the Dow Jones Industrial Average, and it started off in the day, ignited it, and it continued all day long. By the end of the day, I believe Caterpillar was down almost 7% by day's end. The market started continuing to fall midday, and earlier in the week, there's other events that happened, but Netflix earlier in the week, they had reported they were losing subscribers. But Netflix just raised, they just had a price hike on the subscription price. So in my head, it makes sense that Netflix should be losing subscribers. But when you think about it, with the fact that Disney's losing subscribers, now Netflix is losing subscribers, so the whole media business is losing subscribers. So you can kind of see that money managers are probably saying out there, hey, you know what? Maybe I should start selling down my media stocks. And you see that sort of kind of makes sense when you think about that together. But again, that selling continued through Friday. In addition, Verizon came in on Friday, and they lost 36,000 subscribers. So now you got Verizon, you got Disney, you got Netflix losing subscribers. But what's funny about that, what people don't realize in the background, is that the analyst had predicted that they were going to lose 49,000 subscribers. So the fact that Verizon came in and they only lost 36,000 subscribers, that was actually a pretty good number. But that kind of got lost in the whole sell-off, in the whole media thing on Friday. And man, I'm telling you, it hurt. It hurt bad with the market being down so much. And then it just continued. So then on top of all that, now, of course, we do our analysis on many sectors, and we had noticed earlier in the week that, it looked like that some of these, that we're seeing a sector rotation out of healthcare stocks. And if you understand what's happened, with China, they had that extra COVID epidemic. And so for a while there, last month, you actually saw the pharmaceutical stocks and drug manufacturing stocks moving up. But it's been kind of tapering off. And then when you see the CDC in the United States, they released the mask requirement for travel. All of a sudden it's like, oh, well, maybe, we don't need to manufacture all these drugs, as much as we need to, as much as we have to. And perhaps we're kind of overdoing it. So our feeling was that some of the companies were kind of coming a little bit light on some of their earnings. And that's, in fact, what actually happened. So Friday morning, there was a few of the healthcare stocks, and they had some disappointing misses on their earnings report, and that just exacerbated the sell-off with the market, and so it kept selling off. Finally, Friday, there was a dearly loved CEO. She's the CEO of the Gap. Her name is Nancy Green, and she unexpectedly announced the fact that she would be leaving the Gap. Now, Nancy Green, she's a well-loved CEO, and she ran the division of Old Navy. She made Old Navy what it was. I mean, many of you who shop at Old Navy and know all the deals and discounts they give and everything like that, that was all her idea. And so she made the Gap very, very profitable, with Old Navy, and they had appointed her to the CEO of that. So her announcing her, automatic retirement, or not retirement, but leaving the company, that kind of spooked the retail sector. So now, if you own the Gap, and the best loved CEO who created all the profits for the Gap is leaving, what would you do with your stock? So people pulled the trigger on it, and they started selling the Gap. So when you think about it, all these events went together on Friday and caused, in my opinion, a lot of profit taking. The market plummeted, and it ended up the day down 981 points on the Dow Jones Industrial Average. So I think it was a lot of profit taking, sector rotation out of the media stocks, sector rotation out of healthcare positions. So our analysis is, I believe there was a lot of profit taking today on Thursday. At our firm, again, our analysis told us to start rotating out of the healthcare stocks, as I said before, and get out of that arena earlier this week, and we did do that. And Friday's healthcare misses just confirmed that we were correct in that. And it makes sense that other money managers were doing the same thing and rotating out of their same positions, again, selling off. Bottom line, though, the emotional aspect of the sell-off actually was sparked on Thursday with the Fed Chairman Powell saying that he was going to raise it 50 basis points. And when you think about it, that's going to spook the market. Why? Because it's an increase too much, too fast, in my opinion. And again, remember what I said at the beginning. Money managers like certainty. But then when you start wavering and say, oh, we're going to raise it 50 basis points, you're creating uncertainty in the market. You should stick with your 25 basis points per quarter and not spook the market by saying you're going to raise it 50 basis points. Again, money managers like certainty, calm certainty, and not uncertainty. So, that sparked the sell-off on Thursday. It's funny. With a little bit of bad news rolling out on Friday, many money managers were just across the board taking profits. Now, our expectations are that this coming week, that we're hoping that the market will settle down and that it will continue its pace upward in the coming weeks. Now, coming up this week is a big week for the market. We have some major companies reporting earnings, and some of these companies are the biggest companies in America, and they are in the top 5 of the biggest companies in the S&P 500. So this coming week, we have Facebook reporting earnings, scheduled to report earnings on April 27th. The reason I say scheduled is they tell us that's when they're going to report earnings, but sometimes they don't. They might move it a day, ahead or a day back. Normally they'll delay it a day or something, but they're scheduled to report on the 27th. Then you have two of the biggest companies in the United States, Apple and Amazon, and they report on the 28th. So they're reporting on first quarter's earnings. So when you think about it, that's January, February, and March. So they're reporting on the profitability of that quarter, the first quarter. Now, if you know seasonal sales and things like that, after Christmas sales, holiday sales, I'm not expecting those earnings to be magnificent because it's the months of January when it's freezing cold and not a lot of people are shopping, and they're not building houses and things like that because of the cold weather in the north. So typically the earnings for the first quarter are not that spectacular. I'm expecting them to be normal earnings. I'm expecting them to beat expectations, but I'm not expecting them to be spectacular. But they still should be good earnings because the country is in a very high growth pace right now. Furthermore, what I wanted to say is that let me just tell you a quick story. It's funny, I was talking to a colleague back in March, and that's when the Fed actually raised the interest rate. I was talking to a portfolio manager of ours here at the firm, and the Fed raised it 1/4 point. If you remember, once they did that, the market started going up, and it kind of continued up after that. And everybody was happy. Kumbaya. The Fed finally raised interest rates that they were talking about in November, and here goes the market. What was funny is I mentioned to that person, I said, as long as the Fed sticks to its 25 basis points rise in interest rates per quarter, I said the market should make a steady recovery. I said, but if the Fed hints at a 50 basis points rise, it will spook the market. Why? Because it is too much, too fast of an increase. And unfortunately, I was correct, and that's what happened on Thursday. Again, it's just experience being in the business, in the financial business for so long, that you start to understand how money managers think, and then what makes them feel uncomfortable and what causes them to react one way or the other. But again, it's emotion. When you think about it, it's just purely emotion. If the Fed is raising interest rates because we have inflation in the country, they're raising it to keep inflation under control because the economy is growing so fast. That means the stock market will move higher in the long run. So one more thing I'd like to point out is some telltale signs. One historical telltale sign, which I've used for years in the market, is the transportation index. Many people say, so goes the transportation index, so goes the market. And we saw here this April that the transportation index was moving up. Now, when you think about it, what happened this week? What happened this week is that the CDC removed the mask requirement on airplanes. I was talking to my wife, and she said that she had seen a video where somebody had videoed on the plane. They were videoing, and the captain announced on the plane that you can remove your mask in flight. So everyone removed their mask and they clapped, and that's a good thing. But the great thing about that is that indicates that hopefully it will encourage more people to travel. And if more people to travel, that's good for the airlines, it's good for business, it's good for our country. That helps hotels, it helps rental automobiles. It just helps everyone that you have more travel. And again, one telltale sign, one historical telltale sign, is so goes the transportation industry, so goes the broad market. And again, the transportation index is moving up. And just to disclose it, on our current portfolios, we own the transportation index in our accounts. So what are our actions? Our actions are that we remain equity heavy. However, if the market does progress, we remain equity heavy in anticipation that it will progress upwards. But if it doesn't progress upwards, we will take further action down the road through sector rotation. But we believe you need to be equity heavy in this economy. This economy is strong, and it doesn't make sense to be in cash. It makes more sense to be in a heavy equity position. Now, lastly, what I want to ask of our clients who are listening to this podcast and watching it, to our clients, I would like to say, what I'd like you to do is try to take a big step back. Joe Cantu and our other portfolio managers together, we're saying to you that our forecast is that the market is in a long-term bull run up. That's what the market is. It's in a long-term bull run upwards. It's been in a long-term bull run upwards since March 16th, 2009. That was after the financial crisis. Now, there's been years where it had a little blip, but overall it's in a long-term bull run with short-term pullbacks. So this is a short-term pullback. No question about it in my mind. It's a short-term pullback. The economy is heated up. It's doing well. It's growing, which is why the Fed is raising interest rates, is to slow down the economy, kind of put the brakes on, if you know what I'm saying. So if you can keep that in mind and understand that when you see these sell-offs, understand that we at the firm are taking corrective action. We're sector rotating. We're moving out of certain sectors and rotating into new sectors, as we see different sectors move. The goal is to try to own our goal is to own the 5 best sectors for the month. That's what our goal is in your portfolios. And, my belief is we do a good job of that. Now, I enjoy watching the market, and all of us, who manage your assets enjoy watching the market and trying to understand the market. We don't want to lose money, but today everybody lost money. The market was down almost 1,000 points, and we're equity heavy. So it's unfortunate. But if you can take a big step back and take a look at the market and understand that it's in a bull run, and focus on the long-term aspect of the market and not the short-term pullbacks of the market, it'll get you through those days where you might find trouble sleeping at night because the market was down and you lost a lot of money that day. So if I ask you to do that and keep that in mind, because long-term the market is doing well. Now, one last thing. I've said this in many podcasts before, but some of the biggest earnings for the year are in the month of July. July is one of the biggest earnings month of the year. And think about why. It's because instead of reporting off of January, February, and March, then July's earnings are reporting off of April, May, and June. What happens in April, May, and June? Well, the snow starts melting. People get back to work. They're starting to build houses. You have more money being spent throughout the country. You see what I'm saying? So typically July's earnings are some of the strongest earnings you have of the year. My expectations are they will set some records on just how much money many companies made in July, and I'm hoping that that'll be the instigator, the ignition to spark the market on a full upwards trend. But right now, I'm hoping, in addition to that, I'm hoping that this week that Apple reporting, Facebook reporting, and Amazon reporting, I'm hoping it will turn the market around and get it pointed in the right direction. but we'll have to remain diligent on that and see. This concludes my podcast. I have some disclaimers at the end. Take a listen. Thanks.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management is a fiduciary, registered investment advisory firm in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.